Hello, everyone. I hope you can hear me. A very big welcome to you all. I'm Nicola Pogson, and I'm Director of Alumni Relations, and I'm very happy to welcome students and alumni who are joining us from around the world. We had sign-ups from 28 countries. So this is an interactive webinar, and you can post your questions at any time in the Q&A. I think by now we all know what the system is. Upvote each other's questions to give them the best chance of being answered. And Oliver will get to as many as time allows during the session, but we might not be able to cover everything. So I'm absolutely delighted to be joined by Oliver Woolley today, who has kindly offered to share his expertise on raising equity investment. And Oliver has over the years organised a number of events on campus at the college on this subject, but it's a fantastic opportunity for us to bring his expertise and insights on this online version, and also just be able to share this globally, and that's really an advantage. Oliver graduated, we were just talking, from Imperial in 1992, so almost 30 years with an MBA. And he is CEO of fintech company Envestors, which connects investors and startup companies. He's a valued member of Court at Imperial, a board member of the UK Crowdfunding Association, UK CFA, and was a board member of the UK Business Angel Association from 2008 to 2014. So I'm going to hand over to you, Oliver, and thank you and very big welcome.
Thank you very much, Nicola, and thank you to Nicola and Anya and the team for putting this on. I mean, I think you've done an outstanding job. I thought we might get roughly around 50 or so people, and I hear that there are over 200 people who've registered. I'm just looking, how fantastic. We've got people from Delhi, Istanbul, Switzerland, Nicaragua, Indonesia, and sunny Berkshire. So welcome to all of you from around the world. My name's Oliver Woolley. I've got slides to go through about raising finance. I've got quite a lot of slides. I'm going to go through some of these at pace. And then if there are any particular questions, please use the Q&A. These slides will be made available through Imperial, and I'll be providing my contact details at the end. So here's the agenda. I mean, hopefully you've seen this. This is why you're here, and I'm going to be covering all these topics throughout the session. We've got an hour for this. I intend to be speaking for about 40 minutes and then open it up to Q&A. So please, I encourage you to use the Q&A function as we go. So just a little bit about me. I was at university in Bristol, and I decided not to become an accountant, and I set up a catering business. I was the sort of the finance person. And it was sort of an exciting thing to do, so I took the entrepreneurial path. I did an MBA 30 years ago, a full-time MBA in entrepreneurship, and I have to say it was an absolutely fantastic journey I had in my 1 year, and I had no idea that other entrepreneurs were going through the same challenges and pains as I was. After I finished my MBA, I came back to discover that my business was nearly going bust, and I was losing around £10,000 a month. I had a little bit of luck. Goldman Sachs said, listen, can you just do us 2,000 lunches a day? And then it turned around, and ultimately I sold it quite well to Northern Foods in 1997. In 2000, I started investing, and then, as someone pointed out, my investment track record was unblemished by success. In other words, all three investments I made went bust, so I stopped. And at that stage, I thought there must be a better way of investing, and realized that we want to do more to help and educate entrepreneurs and help and educate investors. So that's why we started Envestors. I founded it with 3 others, and it was matching entrepreneurs with investors. In 2014, we launched an online investment platform, and I was thrilled and delighted to be invited to become a member of Court at Imperial College. And I'm a massive fan of Imperial. I've done a number of talks at the college, and when I've been to China or the UAE, I've met groups of Imperial alumni there. So just a bit about Envestors. As we said, we're matching entrepreneurs with investors. We have our own private investor club, which has got around 4,000 investors who've invested around 125 million in 224 companies. £42,000 is the average investment per investor per deal. We get around 100 decks sent to us a month. I can get up to 5 decks sent to me a day, and we normally get that club does around 2 investments a month. We're based in London. We have operations in the UAE and in China. We're actually interested to be expanding in other international territories, but we'd like to think of ourselves as experts in the UK investment market. We're authorised and regulated by the Financial Conduct Authority, and we're very, very involved in the early stage market. We were voted the most active business angel network in the UK by a third-party research group, Bowhurst, and we've won lots of awards and all that sort of stuff. We also now have a number of other sector-specific investor groups that sit on our platform, and we help connect them. So we have investor groups like BritBots who deal with robotics. We have JPIN, who are an Indian-based network. We have Capital Kinetics that focus on medtech. So we have a range of different investor networks also on our platform. So I'm just going to reel this back. I looked at the 200 or so people who registered, and most of them were saying, we're looking for money. So, and that's what we get, and that's what we hear about. We need money. We need investment in order to launch our startup or scale up business. And the first thing is just to make people aware of the myriad of sources of investment and funding there is out there. So I'm just going to run through some of them. Crowdfunding, I think, is something that hopefully most people are fairly familiar with. The 2 largest crowdfunding platforms are Crowdcube and Seedrs. They were due to merge, and they announced the merger last October, November. And I was quite involved with the Competition and Mergers Authority, and bewilderingly, it didn't go ahead. Notwithstanding that, it's definitely it's here to stay, and it's a good source of or a good way of raising money. However, there's a number of sort of challenges that I put down there on the right. So I'm just moving my video. There are, I don't know, I dare say some of you might already be involved or have tried equity crowdfunding. But one of the main challenges is that a lot of serious investors have a lot of reservations when it comes to crowdfunding. But it's still something and we think that companies need to consider it, if only to reject it as a potential source of investment. There are a number of seed and EIS funds. There are 3 that I've written down here. You can invest sort of £150,000 under the SEIS, the Seed Enterprise Investment Scheme, which we'll come on and talk about. And you can search and Google for these, and there's quite a lot of them about. The main challenge there is that they are absolutely bombarded with opportunities, and it does take quite a bit of time to go through the process. There are a number of regional funds. So this is, again, we're just really looking at the UK market here. There's money in Wales. If you want to go to Wales, if you don't mind going to Wales, I mean, Wales is a lovely place. There's loads of money in Wales. And if you don't mind, or if you think you can set up in Wales, then the Development Bank of Wales have grants, equity funds, loans, and various other things to support businesses in Wales. There are a number of different regional development agencies and regional networks who are keen to invest anything from £50,000 up to £2 million in early stage growth companies that will also set up in the local region and employ local people. So They're also trying to get investment outside of the Golden Triangle, which is Oxford, Cambridge, and London, and trying to encourage more activity and stimulate more activity out into the regions. VCs, there are a lot of VCs. If you go to the British Venture Capital Association, you can find a whole list of VCs. I've just written 4 down there on the right. Actually, we work quite a lot with Side by Side, and we work with Beringer. We work with a number of different VCs. The main challenge there is that they're not really, they say they'll do early stage and startup, but they very, very rarely do. Usually, a lot of them have a minimum revenue threshold of about £1 million, but they can put in £500,000 and actually can help grow with the company. We've actually seen a lot more interest from international investors. The UK is a fantastic place and it's got very strong reputation for tech and innovation. We're seeing a lot, particularly from China and the UAE, people looking to invest into UK entities. We have done quite a lot of stuff in China. There's just an example of one of the events that we held out in China. We're also Home Office approved endorser visa. We're a Home Office approved endorsement visa company. So we help people come to the UK. There are challenges from a company's perspective, but it's a great potential source of revenue for certain companies. So we get asked a lot about private investors and who are these private investors and business angels or whatever they want to be called. So we get a number of different types of private investor. Typically their net worth is around about £10 million. They've got half of that in property, a good section in stocks and shares and bonds, and this is their top sort of 5% that they want to play with. We've got a number of different profiles of investor. We've got the sold out entrepreneur. Typically, as an example, we've got someone who sold their digital marketing company and they put in £200,000 into another digital marketing startup and join the board and help them to grow. We have the wealthy professional. We've got a head of desk at Barclays Wealth Cap who gets a £500,000 bonus a year and wants to make 10 investments of £50,000 in order to get some EIS tax relief. And we've got the hard ex-chair of P&O who actually wants to give something back and to help and nurture early stage companies. From a regulatory perspective, not that it's relevant, but these are the different types of investor. Crowd investors who can put in anything from £10 into a deal, and then sophisticated investors, high net worth, and professional investors who are people like VCs and the like. One of the bits of work that we're looking to do with the UK BAA is just to try and broaden the diversity of investment. Sadly, it's still too stale, male and pale. And actually, we're trying to do more to encourage investing in unrepresented founders. So one of the things we like to do is just to make sure the entrepreneur understands the investor. We also do a talk to help the investor understand the entrepreneur. So what we find useful, and I hope you'll find this useful, is for entrepreneurs to understand what makes the investor tick. So we ask our investors the whole time, why are you investing? And we get a range of responses. But the number one is that they're looking to make spectacular gains. In other words, they're looking to back a business which can make huge amounts of money. Remember, the other key factor is they're already wealthy individuals by definition, and they're sitting very comfortably in their armchair. They don't have to make the investment. So it's got to be particularly exciting and interesting in order to get them out of their comfy armchair and to get them to make investment. So they are looking for spectacular gains in terms of they've got their portfolio of investments that might earn 1 or 2 or 3%. These are the things where we're looking to knock the ball out of the park. Here are some of the other things we hear from investors. They want to use their own judgment. They don't want to hand their funds over to a wealth manager who's going to invest it on their behalf. They want to bet on the nose and pick the winners. They want to be a part of something and contribute to the success of that company. EIS tax relief is a key factor, and I'm going to touch upon EIS in a sec. And there's a lot of sort of, they just like talking about it, and they like to be engaged. We've had last week we had a young 30-year-old guy who is a successful insurance broker, and he's new to investing, and he just finds it so exciting seeing all these wonderful entrepreneurs, and while he's sitting there in to his own admission, relatively boring job as an insurance broker. And there are some investors who just say, I want to do stuff that's going to help make the world a better place. But notwithstanding that, that's not going to be philanthropic completely, because they're still looking to make a return. And these are the complaints we hear from investors as to why they're not investing. But one of the main reasons is it's very illiquid stock. You can't sell your investments. You invest into an early stage company, they'll all say exit trade sale between 3 and 5 years, when actually, typically the average holding period is around about 7 years. It's also very risky. A lot of them go bust. And I'll talk about the current effect of COVID and what the current feelings for investors are, but a lot of them are protecting their own portfolio. And the other thing you'll find is that investors, there's a lot of other places that they can put their money. So we get asked, well, what does a good deal look like? And these are the things that that stick out. Valuation, and I'm going to talk about this more in a sec. Management who are full-time, and this isn't a hobby, this isn't something that they're just playing around with. They are 100% solely focused on nothing else other than making the business success. The other key is to get a board. Now, a lot of early stage startups don't have a board, but it's a useful thing to start thinking about doing to enable you to facilitate growth. If we get a email and at the bottom the signature says founder, president, chair, CEO, and the like, actually that's not going to give investors a lot of confidence about decent corporate governance in helping to manage the growth of the company. So having an independent chair, an independent board, it will take time, and you don't expect to have it tomorrow, but it's the sort of thing that companies should aspire to have. And quite often as part of the fundraising process, it could be to say, actually, we're looking for a chair who can invest £50,000 and join the board and also help with the rest of the fundraising. We're looking for potential for explosive growth rather than just a lifestyle business which will tick along, tax relief under the EIS, and actually the exit of understanding how and when the investor is going to make a return. The other key points is it's got to be a fantastically wonderful and exciting story. And also you've got to be fully investment ready, and I'll touch upon what that means a little later on. We also get asked what's hot at the moment. These are key areas which are getting the most interest at the moment, because of environmental propositions, medtech, well-being in the top right, robotics, fintech, and AI in the bottom right. These are the sorts of things which we're finding are getting the most interest at the moment. Now, mindful of the fact there's some people that might be looking to raise investment and their company is not located in the UK. And that's something that needs to have some consideration. There are a lot of benefits for setting up in the UK if you're trying to seek investment from the UK. For a start, tax relief, EIS tax relief, can only be gained if the company is a UK registered limited company. And as it says there, investors are a bit nervous about sending their money abroad. So we find that the success rate of companies looking to, for companies based abroad to raise money from UK investors is relatively low, mainly because there's no tax relief and there's concerns about the legal legal structure as well. So it's just something to think about, and what might be best is, if you are a non-UK company, would be to look to set up in the UK if you're looking to get investors in UK investors. So we speak to our investors all the time, and we probably get 30 or 40 new investors registering with us a month. And we say, well, how are you feeling with the current restrictions? I have to say, this was done about 3 months ago. So we're going to be interested to see how people view things. We've seen the FTSE go up to over 7,000, giving a bit of confidence. Okay, it dropped right back down again. But actually, the general trend is that people started to come out of the woodwork. But the main thing we're hearing from investors is they're doing a lot to support their existing portfolio in terms of sort of keeping their powder dry. Notwithstanding that, they're still looking for fantastic and exciting opportunities, and really good opportunities do get funded. The clear thing to look at, and we get a lot of propositions sent to us, is why you're raising money. And we get quite a few companies which have struggled, and they are really raising investment to survive and to keep the lights on, which is fine. But the most common source of investment would be through that company's existing shareholder base. It's very difficult to get a new investor to invest in a survival situation. And we've had some companies which have struggled very sadly, and then they've gone through a process in order to clean out the balance sheet and to sort of almost start again. And there are recovery agencies that can help do with that. So it's quite important to identify the reason why a company is raising investment. So we've done over 200 investments, and actually 3 of our biggest winners they started in the last recession. ChargeMaster, which does electrical vehicle charging points, which started off at a 2 million valuation and was acquired by BP for over 120 million. Ebury, which was foreign exchange trading platform, started in the last recession and was a unicorn when it was valued at $1 billion when Santander invested. Parking Eye did vehicle number plate recognition software. They managed to get through. They nearly went bust in that recession, but they ended up selling to Capita for 50 million. And the 3 investors who collectively put in 125,000 walked away with just over 13 million. So, I mean, this is why it's a really, really exciting asset class for investors to participate. So we get asked, and we ask our investors, well, why don't you read the business plans that you get sent? And I get sent, obviously, direct, I still invest, and I get sent business plans. And one of the main frustrations is it doesn't really cover all the information I need to know. So firstly, it's just sort of, and this is, I don't mean this to be a scary statistic, but it is quite challenging to raise money. And this is work conducted by Mason Harrison and looked at the life expectancy of a business plan raising investment from completely third-party sources, i.e. not friends and family within their own networks and things like that. And they estimate that only 2% are successful and that 60% are rejected very quickly. Smith and Williamson did some research. It's very, very difficult to do research in this market because working out what is a connected and what isn't a connected investor. But it sort of shows that there aren't that many that get funded. And if you look at Crowdfunding Seeders, who are probably the biggest and most prolific investment platforms in early stage companies, they might only do 100 or 200 a year. And we speak to, as well as private investors, to funds and VCs and various other people. Simon Carver was with the Business Growth Fund. He is the chair of the UK BAA, and they made 12 investments from looking at over 1,500 business plans, which were sent to him. And so that was less than Well, that's less than 1% sort of conversion rate from the ones that that did finally get funded. And he said that the biggest problem is that you'll get sent a deck saying about how lovely and wonderful the product and the market and the people are, but actually you need to make sure you've got all the other bits in order to help make an educated decision. So investment decks, they need to support the business plan, and they need to make sure that they've got the relevant information so that when an investor looks under the bonnet, they can actually see all the stuff and it all makes sense. As an investor, it's very frustrating when you get a really, what looks like a fantastic proposition, and then it takes you 2 or 3 days to dig through and to get all the information. Then you find there's a massive hole, like the IP is owned by someone else, or there's an undisclosed VAT bill for £250,000, or there's a director's loan for £500,000, or there's legal wranglings going on somewhere. So it's quite important to make sure that once you get an investor interested, to increase the conversion rate of actually getting investment. So I'm not going to go through all of these. These are available for people if they want to have a copy of the slides. But this is to support the business plan. It's clarifying what the investment terms are. And again, it's very frustrating. I might say it's a fantastic business, but actually, what's your share price? If I invest £25,000 or £50,000, how many shares do I get? And actually, if they don't know the answer to that, then it's a little bit of a challenge. Sorting out the valuation, and I'll come on to that, as well as the legals, and then the finances, make sure there is a signed off balance sheet. And the purpose of that balance sheet is to show how much the company owes and how it's been funded to date. And this is also a key issue about how investors will get a return, how they will get their money back. And the exit route and the exit strategy will say things like, oh, trade sale flotation in 3 to 5 years is a typical one. Actually, in the vast majority of cases, an exit is done through a trade sale, an acquisition. And that's with a larger company buying the company out. So tax is boring. We know tax is boring, but tax is a real fundamental issue here when it comes to dealing with investors, certainly in the UK. And just to sort of have a quick recap, under the Enterprise Investment Scheme, if I'm a UK investor, a UK tax-paying investor, if I put £100,000, I get £30,000 back from HMRC. So my net investment is 70,000. If this risky venture goes bust, I get a further 31.5%. So I'm actually only risking 38.5%. There may be some additional other capital gains reliefs that I've got personally that could actually reduce that down even further. So this is a very basic amount of tax relief that you can get. So the UK, the investor has to be a UK taxpayer, and the company has to be a UK registered company that's got assurance under EIS. For the very early stage companies, there's a seed EIS scheme, which is even more tax relief. If I put in 10,000, I get £5,000 back. If it goes bust, I get 22.5% back. As an investor, I can do £100,000 a year. As a company, I can raise a maximum of £150,000, and it's for very early stage deals. So it is a wonderful tax relief. It doesn't look like it's going away. So, and it's very important that the company gets their paperwork sorted out. And we highly recommend that you don't try and do this yourself. You get an advisor to help you to put in advance assurance if it's required, but to seek advice. The HMRC have taken a view that they are now, their default response is no, or come back with more information. But if you have a good tax advisor, they can get this through in under 4 weeks. R&D tax credits, again, these are things that you need to be thinking about as an entrepreneur looking to raise investment. And Envestors Limited, as a company that we have, we've raised £2 million to invest into our online investment platform, which we now license to other organisations. we get around about £80,000 back a year in R&D tax credits. And so it's a really good source of money coming back into the. So legals, and we do this to try and educate the entrepreneur and try and educate the investor. You don't have to be an expert, but it is really, really helpful to understand just some of the basic legals so they don't unravel and it all goes completely wrong in years to come. So as a UK company, so we're just talking about UK companies, you don't have to, as a UK company, you don't have to have a shareholders agreement. A shareholders agreement is a private document, which is a contract between the shareholders and the company. The articles of association are a public document which are on Companies House. And actually, you don't need to have a shareholders agreement. It can be, all of the investment terms can be in the articles of association. In either case, there needs to be a subscription agreement, which is actually saying, well, what the share price is and outlining the terms of the share offer. You'll then also need a deed of adherence. I won't go into that now, but I can tell you where to find out more information. There are other investment products or ways of investing, like convertible loan notes and advanced service agreement, subscription agreements, which I won't go into here, but there are other things. We like to try and keep things nice and simple so that the entrepreneur understands it and the investor understands. And there are some key terms that you need to be aware of. The main ones are tag-along rights and drag-along rights. So tag-along rights are very good for the investor, so they can tag along to a deal. The drag-along rights are really good for an entrepreneur who can drag an investor into a deal if and when, for example, the company is being acquired. There are preemption rights and various other ones. Again, I'm not going to go through these now. And actually, in our guide, it explains, it's only about 3 pages, the bit on the legals, but it's really, really helpful for both the entrepreneur and the investor to say, okay, these are the things that we just have to look out for. You can get advice. There's seed legals that do these types of, that can help with the legals. They're good. They're a good place to go to if you know what you're doing, because you'll need to have a lawyer, or you still need to have some legal advice to help you with them. And we work with CMS, Nabarro, Olswang as well, and there are lots of others. But it's really good just to get a good team lawyer on board to help with these. So what's the biggest reason that companies don't get funding? And really, it comes down to valuation. Now, I've got 5 minutes left, so I'm going to talk a bit about valuation. We do a whole session just on valuation. And this is the sort of things that can impact a valuation when valuing these. These are unquoted private companies. So they're not quoted on a stock exchange where we know what the price per share is. These are unquoted companies. And there's 2 at a very high level. There's pre-money and post-money valuation. And the reason we put this up is that actually, we've been in investor meetings years ago in the past where they're talking about valuation, and actually they're talking about different types of valuation. So a pre-money, a post-money valuation, or if you're receiving investment of 400,000 at a post-money valuation of 1 million, that will mean you're selling 40% of the company, or the investor will get 40% of the business, which means that it's a pre-money valuation of 600,000. If investing 500,000 at a pre-money of 1 million, then the post-money is 1.5, and it's 33%. So that's just, we generally speaking, if you look at any of the investment platforms, they're talking about pre-money valuations. And these are just some examples. So, and we've got mountains of examples to go through. But if you just take the middle one, this is a company which is a communication software company that was turning over 3 million and profitable. And they raised £500,000 at a 3.75 million pre-money valuation. So if you're going to look to, if a company is, let's say, pre-revenue, an early stage, with showing lots and lots of promise, but they're still relatively early stage and they're trying to raise money at £3 to £4 million. Investors will compare, the generic investors will look at your valuation compared to another valuation. So valuation is fairly key. Now I'm going to run through these at a bit of pace. If anyone is more interested in the valuation, then it's something that we can either do another session on, or I'm gladly speak to people about. And there are 5, I'm just going to go through 5 key valuation models. There's a discounted cash flow model, which basically looks at future earnings. Now, the challenge of looking at future earnings in 3 to 5 years' time and then discounting it back to a net present value is you're basing on future, and we don't know what the future is going to hold. And there's been some previous research that only 4% of companies which got investment met their highly conservative sales assumptions that they put in their business plan. So actually basing a valuation on such unpredictable data is pretty difficult, but it's still something to use. And we've got a financial model which looks like this, and we can make it available to people to have a pay should they wish. There's the historic matrix, which looks at investment data and performance data, and that's more appropriate for established companies that have some existing data to show. And this is how the matrix works. So this was based on, we did this ourselves, some proprietary research, and based on around 30 individual investors, private investors, who made over 200 investments between them. There's a sort of a simple bottom-up analysis. We're looking at investment and sweat equity, and here's a sort of very simple model that basically you're ascribing a certain amount of value to the sweat equity of the management team. The most simple one is the Burkus method, which is basically a very simple. It's great because it's simple. It's not great because it's simple. But it's fair. What it does is says, right, we'll ascribe £400,000 worth of value to the pre-money valuation up to a maximum of £2 million. And it relates to 500,000 per item up to a maximum of $2.5 million. So that's another useful thing. Probably the most accurate and relevant is looking at other deals which are out there in the market. You can go to various research tools like Bohurst, Crunchbase, and various others, or you can look at the crowdfunding platforms or any of the online investment platforms and just look at what other deals are being offered. The challenge there is that valuations on a lot of the crowdfunding platforms are massively overinflated. So, and we're never sure if they are actually getting funded. And also, the jury is out as to whether or not these crowd-funded companies are going to make a good return for investors on the valuations that they have put in. So another question we get asked is, well, how long does it take? So it's a real, as we say, it's a marathon, not a sprint. It takes sort of 3 to 12 months. And it's almost something that you've got to think about. On average, it might be 4 to 5 months. So when we get people saying, right, well, we think we're going to raise money in 6 months, so we'll sort of think about it in 3 or 4 months. Actually, you should be thinking about it now. We've got 2 contrasting case studies. One which took 7 months, which was massively painful. And basically, they just went out sort of unprepared at an unrealistic valuation and completely unrealistic expectations. And then they did have a bit of bad luck, but it took a lot of time. And then the opposite of that is that we had another case study where they were super well prepared. They had a really sensible valuation, and they managed to raise money in a heartbeat, and it was really good. So what we're about is not only trying to educate the entrepreneur and the investor, but we're desperately keen to try and get better deals done. So that's it for the presentation. I hope it hasn't put people off. We love entrepreneurs. We're all about entrepreneurs. And if you are thinking about taking the entrepreneurial route, wholeheartedly hope that you do. There's a couple of quotes here. The great quote from Mark Twain: 20 years from now, you'll be more disappointed by the things you didn't do than the ones you did do. So throw off the bow lines, sail away from the safe harbour, catch the trade winds in your sails, explore, dream and discover. That's probably one of the quotes that got me interested and excited about taking the entrepreneurial path. And dear old Woody Allen said 8% is just turning up. And the point about there is that actually you've got to stick at it through thick and thin, and sort of drive, determination and tenacity and enthusiasm counts for a heck of a lot as well. So that's it from me. We've got 10 minutes for questions. Here are my contact details, and we can make these will be available from the team if you require a copy of these slides. So that's that. I'm going to now look at the Q&A and to okay. Do you think that London will be compromised as a European HQ for future focused private equity, obviously as a result of Brexit? Well, I don't think it will, and I was not in favour of Brexit myself, but actually it's going to be a phenomenally good place to for tech companies to set up. And there are two independent reports, one the Khalifa report and one the Battery Ventures report, which certainly highlighted the fact that the UK was a really good place to setting up. How does one find angel investors who are knowledgeable about our industry rather than generalists? To find investors who could open doors, provide value-added connections and advice. A really, really good question from Ramin. That is really where you should be working your own networks. And I'm a big believer in LinkedIn and actually thinking, right, let's find other people in my industry, key opinion leaders, through direct and indirect connections, and actually go and approach them. And for a start, the first thing you do is you can ask for advice, and then you might get money. If you ask for money, you might get advice. So asking them advice in the first instance is something that we highly recommend. There are also sector-specific groups. So we work with Speedia Capital, who only invest in automotive technologies. So finding sort of niche groups like that through your own research is a really helpful thing. What are the bare minimum requirements to seek the earliest possible funding, MVP business plan? Well, these are all great questions. I think it's never too early to start the process. And actually, as I'm just following on from the previous point, just engaging the investment community early and identifying appropriate people and explaining what you're doing is a very good way of actually building momentum in order to look to try and then raise investment going forward. So I know it's never too early. And also some investors like investing at a really, really early stage. So it's engaging and investing in this early stage investment community. The earlier, the better. And then you'll sort of build relationships, and relationships are very important because people invest in people. When you ask investors, what's the most important thing about investing? They'll say the management team, management team, management team. So developing those relationships are really good. What type of investor would you recommend for a marketplace SaaS business that has yet to begin trading? That's quite a specific question. I don't know the answers to the top of my head. Marketplace ventures are quite challenging to raise investment for certain ones are, where what they tend to be doing is they only get value once they've got to some critical mass, and they need to build a massive user base or client base before they'll generate some value. So that's a marketplace. If it's a marketplace and a SaaS, it would, I don't know if they're two separate things, but you know, if I don't have any immediate answers to that, but actually, if you drop me a line, I'm sure I can find out people who will know. What would the particular risks opportunities be for the VCSE organisations that might be looking to outside investment to further the impact they make, which generally will not be focused on financial returns? So this is this is a so this is I think looking at sort of not-for-profit social social or impact investing. If it is, certainly there are a number of organizations that like impact investing and social enterprises. I'm just trying to think of some off the top of my head. There's Earth Capital, there's Zero Carbon Capital, there's Impact Plus. There are various other networks which are very focused on the impact, and actually impact investing and social investing is actually quite a good area. And a SaaS business seeks seed angel funding before the MV is launched. Development operationals are the main blockers. It can be, it's always much, much more difficult. To be clear, there are relatively few investors, sadly, that tick the pre-revenue startup box. So the most likely source of investment will come from generating interest within your own networks and talking about it and asking for advice. I'm a big believer, ask people for advice and then you may very well get money. The mainstream information tells you that clean tech is a hot area for investors. Nevertheless, in the reality, we see that this is not the case. Do you have any suggestions of where to find such investors? So this is clearly from a clean tech, sorry, the question's disappeared, I think. Clearly this is from a clean tech proposition. There are places you can get clean tech. Again, this is something that, by the way, I'm very happy to do what I can to help Imperial alumni and graduates and postgraduates where I can. If you drop me a line, I could see how and where I might be able to help. Where does grant funding rank in the hierarchy when seed and other funding? That is that, you know, there's something that I've missed out, but grant funding is is very, very useful, non-dilutory. In other words, you're not selling equity. Innovate UK is the main source of grant funding in the UK, and there are people that can assist with grants in the UK. So that's so you could start off with Innovate UK, and there are some grant people who can probably help. I'm going to look to see the ones which have got more than one. Okay, so let me just go near the top. Do you have any recommendations for EIS and SEIS advice for early stage companies? Is MVP more important or company formation structure in getting money? As we say, you don't want the tail to wag the dog. In other words, the EIS and SEIS is more of a hygienic factor. And actually, spend some time on the MVP, because you can get EIS and SEIS, but actually, if you don't have a wonderful proposition to get investors excited, then they're not going to invest regardless of whether or not there's need. With regard to recommendations, there is, we use a small company called Friends Tax Advisors, who we can put people in touch with. And really what you want is a small accountant, but one that really understands this tax relief. So we do have a number of people that we can suggest. This particular one, it's an ex-BDO tax partner, and Sarah Friend is really, really good, and she could help out if that's required. What is the best valuation model to adopt for a medtech startup? Now, medtech and health tech and various things are very, very challenging. So in the various models we've looked at, there are sort of 5 key sectors which are different. One is marketplaces, another one is medtech, and there are different rules on medtech. We've had Network has probably invested in about 30 medtech deals. And one of the key things is to try and expand the number of potential investors. I'll give you an example. We had a company called Cytosurgical Medical Devices that did a laparoscopic. They did a windscreen wipe at the end of a laparoscope, which is a camera keyhole surgery. The guy came in and spent 45 minutes talking to us about very detailed tech on laparoscopy. When it turned out that actually it was just a windscreen wipe at the end to keep the lens clean, and so that the surgeon could do 4 times as many operations in an hour. That was the key benefit. And actually they managed to raise money from generalists, because they understand, well, here is the problem, here's the need, here is a really, really good solution. I know nothing about laparoscopy, but actually keeping it and identifying, this is the market, this is the need and the problem, and we're going to solve this problem, and we're going to make it better than everyone else. There's an IP protection, so it's a much better way. So I'm just looking at other things coming up. So search funds, is the investment process different, and why is it different? What is your opinion on search funds? Not entirely sure what that one means, I'm afraid. I'm going to skip over that one. I'd gladly take it. So what value, again, a bit about valuations, which valuations is most relevant for prospective investors. I think it's and certainly if you're very early stage, you can have discussions within your own networks to try and get some feedback about valuation. Again, asking for advice is another really, really good thing. And actually you can start from there. It's fantastic. There's loads and loads of questions here, but I think we're going to call it, because it's 5 to 4. I'm going to hand back to Nicola, I'll gladly be able to help provide as much as I possibly can, certainly by email. Thank you very much.
Thank you, Oliver. As an amazing run through of and sharing of all your insights and experience and expertise. And there are lots of questions. Sorry haven't got to all of them. We very rarely do manage to, but Oliver's going to take a look at them afterwards, and you can contact him and link up with him on LinkedIn and various things. So he shared his details. We'll share the slides, we'll share the recording, and you can always find the recording on Imperial Plexus at a later date. I've also got a little note here from Victoria Nicol at the Enterprise Lab. So I just want to remind students, current students or alumni who are up to 3 years out, if they need more help, they can also book an idea surgery with the Imperial Enterprise Lab to help you progress your idea and get more help. So there's also that source of support at the college, and thanks Victoria for reminding us about that. I also want to say that we're going to ask you to complete a feedback form, and we may be working with Oliver on more focus sessions if there's felt to be a need for advice in one particular area, maybe a dinner with 12 online or something like that. So, but your feedback is always really helpful to help us improve or adapt our events. I think that's probably it from us. Thank you very, very much, Oliver. It's just fantastic. Really appreciate your support and your inputs, and everyone else. Thank you very much for joining us and for your questions. And we hope you found that helpful, and we look forward to meeting up with you at another event. So have a wonderful rest of day from wherever you are, or early evening, morning, the whole day. Thank you. Bye.